Welcome back everyone to our study of Chapter 6. This video covers primarily the second half of Chapter 6, all about segmented income statements and segmented reporting. So learning objective 4 in Chapter 6 was to prepare a segmented income statement that differentiates traceable fixed costs from common fixed costs and use it to make decisions. So a little quick note here about decentralization. So a segment for our purposes is any part or activity of an organization about which we want some kind of cost, revenue, or profit data. So it might be in some organizations an individual store. If we're talking about like a retail setting, for example, that has a whole bunch of different stores in different locations. It might be a service center. It might be an entire sales territory. Again, anything about which we want some kind of profitability data, however we want to organize operations within the business. US GAAP and the international financial reporting standards do require publicly traded companies to include segmented financial data in annual reports. And what's interesting is that the companies have to report segmented results to shareholders using the exact same methods that are used for internal segmented reports. So whenever the business decides they want to segment internally for purposes of control or decision making, that's how they have to report things to shareholders as well. So there's some sort of implied transparency there. Now this requirement does motivate managers to avoid using the contribution format approach for internal reporting purposes, because then they'd have to share that with the public. And as we spoke of earlier, businesses probably don't want to be sharing cost structure, which sort of comes out in that contribution format income statement, with their competitors and with the marketplace. So I took a quick look a while back at Amazon.com's current business segments, because I always thought they were organized in an interesting way. They break things out into just 3 segments. They have North America, which is basically North American, retail sales, all the stuff that they sell on Amazon.com. Then they had International as a segment, and then Amazon Web Services. And what's always been interesting to me is that Amazon Web Services really dominates Amazon's financial statements. Like for year-end 2020, for example, total operating income for web services was over 13 billion. Whereas for North American sales entirely was 8.6 billion. So Amazon Web Services really drives that company. Every piece of the internet practically runs on Amazon Web Services at this point. So a couple of keys here to building segmented income statements. We should use the contribution format because it separates fixed and variable cost and gets us along this right track of a contribution margin. And then we want to make sure we can differentiate between traceable fixed costs and common fixed costs, because we're going to have a new margin subtotal here on a segmented income statement called a segment margin. We'll talk about that more in just a second. Now, traceable fixed costs come about because of the existence of a particular segment. We say the cost is traceable to that segment. And the point is that the cost would disappear, at least over time, if the segment itself went away. So a couple quick examples here. The salary of the Fritos product manager at Pepsi, we'd say is a traceable fixed cost of the Fritos segment. If Pepsi tomorrow decides they're not going to make and sell Fritos anymore, then they're not going to have a Fritos product manager, at least for much longer. Similar idea, the maintenance cost of the building in which Boeing makes 747s is a traceable fixed cost of the 747 business segment. If Boeing decides they don't want to make that aircraft anymore, then the maintenance costs associated with that building would go away, at least over some reasonable time frame. Also like to use an example in our own setting. So Clemson has a bunch of different colleges, including the College of Business. The salary of the dean of the College of Business, Dean York, we'd say is a traceable fixed cost of the College of Business. If we think about that as a segment within Clemson University. If Clemson tomorrow decided, hey, we're only going to be a school of, engineering alone, we're going to get rid of everything else, then we wouldn't have Dean York around for much longer. Someone else would snap her up immediately because she's fantastic, of course. But the point is she'd be looking for employment elsewhere. So think about this. If a cost is traceable to a particular segment in, say, a manufacturing firm, does that mean the cost must be also considered a direct cost with respect to the production of the segment's products? Pause this, think about that for a second, and then come back for the solution. So the best answer there is actually no. So traceability with respect to a segment might have nothing to do with whether the cost is direct or indirect with respect to some activity within that segment. Okay, so we can't make an unequivocal relation or statement that traceability and directness are associated. Common fixed costs, on the other hand, come about because of the overall operation of the company and wouldn't disappear if any particular segment were eliminated. So a couple quick examples here. The salary of the CEO at General Motors is a common fixed cost of all the different divisions of GM. Similarly, the cost of heating a particular store like a Kroger, a Safeway, a Publix, whatever, is a common fixed cost of the various departments within the store, like produce and all the other different types of things that those stores are selling. Back to our university example, same thing applies. The president's salary is a common fixed cost of all the different colleges, if we thought of those as segments of Clemson, rather than any particular segment. It's also useful to note here that the traceable fixed cost of one segment might be a common fixed cost of another. So for example, airlines pay landing fees to airports to land different flights. The landing fee paid to land an airplane at an airport is traceable then to a particular flight, but it's not traceable to first class, business class, and economy class passengers. Back to our university example, the dean of the College of Business, their salary is traceable to the College of Business, but it's not traceable to the School of Accountancy, the management department, the finance department, and so on. So the level of analysis is very important when we're trying to determine traceability. Okay, it might be traceable at one level, it might be a common fixed cost at another level. Just something to keep in mind. Now in this class, we've already talked about a couple different margin calculations. We had gross margin way back at the beginning of the semester, and we also had contribution margin that we've been using for a while here. Now we have this idea of segment margin. Segment margin is going to be calculated by taking the contribution margin of a particular segment and deducting only the traceable fixed cost of that segment. Now for our purposes, we're going to say that the segment margin is the best indicator or gauge of long-run potential profitability of the segment. And for our purposes, we'll assume that any segment margin at or above zero is a quote-unquote good thing, that a segment is only unprofitable if their segment margin is below zero. So let's look at an example here. Let's say Weber Inc. has two divisions. They make computers, PCs, and they make TVs. So here's Weber's income statement for just the television division. We've got sales of $300,000, variable expenses of $150 total, so contribution margin of $150. They've got traceable fixed expenses, so again, expenses that would go away if we no longer made TVs tomorrow, of $90,000, for a division or segment margin of $60,000. Now that segment margin is the television division's contribution, if you will, to overall company profits. So again, for our purposes, as long as that's zero or above, we're going to say that that segment is potentially profitable, that we shouldn't consider getting rid of it. Now let's throw the computer division's income statement, segmented income statement, side by side with TVs there. Let's say they had sales of $200,000, contribution margin of $120, and a segment or division margin of $40. We also would show the company's total across all its segments, generally speaking. So Weber as a whole then has total sales of $500,000. That was $300,000 from TVs and $200 from computers. At contribution margin total of $270,000 across the two segments. Total division or segment margin of $100,000. The company also has $25,000 in common fixed expenses. So again, these common fixed expenses just come about from overall company operations. Things like executive salaries, top of the house type costs, and so on. And overall net income of $75,000. One thing already worth pointing out here is, again, generally speaking, common fixed expenses shouldn't be allocated to the different divisions or segments because by definition, they wouldn't go away if the segments went away. So we shouldn't be charging or distorting the potential profitability of the segments by allocating those common fixed costs. I would add, though, that this is something in practice that happens very, very commonly. Okay? A lot of times companies do allocate common fixed costs to the different segments, in part to encourage responsible use of shared resources and things like that. So this is one area where a textbook and what happens in practice will kind of diverge just a little bit. Now, back in chapter 5, we did some break-even analysis for the company as a whole, and if they had multiple products and so on. We can do break-even analysis with our segmented reporting as well, and it works just a little bit differently. So that was learning objective 5, to calculate company-wide and segment break-even points for a company with traceable fixed costs. And this does share a lot of kind of overlap with some of the earlier analysis we did in chapter 5. So let's get back to our Weber example here with the TVs and computers. If we want to calculate the company-wide break-even point, we're going to take the overall fixed expenses for the company, that's traceable plus common fixed expenses, and divide by the company's overall contribution margin ratio across all its segments. So just to kind of make sure we're clear on where this is coming from, for Weber, we've got the traceable fixed costs of $170,000 plus the common fixed cost of $25,000 for a total of $195,000. And then that company-wide CM ratio is going to be the company-wide contribution margin, $270,000, divided by company-wide sales of $500,000. Okay, so $195,000 divided by the 54% CM ratio means company-wide break-even sales of $361,000 and some change. Now, if we want to calculate the break-even point for each segment, we're going to do that a little differently. We're going to take just the traceable fixed expenses for the segment divided by the segment's contribution margin ratio. So for TVs, we've got their traceable fixed expenses of $90,000 divided by their CM ratio of CM 150 divided by sales of $300,000, or 50%. Okay, so there's TVs, $90,000 in traceable fixed divided by CM ratio of 50% for a break even of $180,000. Same idea for computers. Traceable fixed expenses for the segment only divided by the segment CM ratio for, in their case, a break even of $133,000 and some change. And just note here that those common fixed expenses for the company as a whole are not included in the segment only break-even analysis, because again, we don't want to hold the segments responsible for these common fixed expenses that they may not control and that are sort of just supporting the overall operation of the business in general. A couple other things to just wrap up here real quick. Costs assigned to a segment should include everything from the company's value chain. So that's everything from R&D, research and development, all the way up through customer service, sort of an end-to-end approach. There are some inappropriate methods of allocating costs among segments, and we've hinted at these a little bit already. Sometimes there's a failure to trace costs directly. So costs that can be traced directly to individual segments shouldn't be allocated to other segments. We want to make sure that controllability and traceability are kind of going hand in hand here. We're holding segments responsible only for the things they can control, all things equal. And then the second would be inappropriate allocation base. So some companies do allocate cost to segments using bases that appear at least arbitrary. So some volume measure, some consumption measure, maybe relative sales value and things like that. Costs really should be allocated to segments only when the allocation base actually drives the cost being allocated. And again, that's one thing I just add an asterisk as we're chatting about it here, or as I'm chatting about it to you. In practice, this happens an awful lot. Cost allocations are very contentious at times because of things like this. A lot of segments get costs dumped on them that don't really appear to have a direct correlation to what they're doing, and that's sort of a management issue. Okay, quick question. So allocating common fixed expenses to business segments then does what? Think about these potential answers, pause the video, come back for the solution. Best choice there is D, may cause managers to erroneously discontinue business segments. Again, if we're dumping a whole bunch of common fixed expenses on individual segments who can't control those, who aren't responsible for driving those costs, then we may make potentially profitable segments look unprofitable, or at least less profitable. And then finally, just to kind of reiterate here, common costs, all else equal, shouldn't be arbitrarily allocated to segments based on some idea that someone has to cover the common cost for at least two reasons. One, it might make the segment look unprofitable or less profitable. And two, allocating common fixed costs really forces managers to be held accountable for costs they can't control. So we're violating what's known as the controllability principle. We should only be allocating things to managers or holding them responsible for things under their direct control. And that wraps up the last of our Chapter 6 material here. Make sure you revisit any topic you need to, and let me know if you have any questions.